Agent banking is a unique type of retail payment system. It is one where the bank controls the customer proposition and the bank controls the channel. So it's very different from other retail payments that we see, that pursue more of a mobile money type approach. The leading examples of bank-led agent banking systems are those that have developed in Brazil, where 3 banks have developed agent banking networks. And you increasingly see it develop in other markets around Latin America and even in Africa and Asia. Peru and Colombia have started to develop agent banking systems. And so, although they haven't really reached the level of development that you see in Brazil. One of the factors that makes agent banking so unique and differentiates it from other retail payment systems that we see is that unlike a typical retail payment systems where network effects and the challenge of incentivizing the cash merchants and attracting customers requires you to get to scale quickly, in agent banking, you don't have the same challenge. There is a possibility to pursue an incremental approach to scale. And this happens for 2 major reasons. First of all, banks, because they have an existing customer base, they're able to migrate their customers to the agent or cash merchant channel. That means that they don't face the same challenges attracting customers as a traditional retail payment system because the customers are already used to using the bank's existing infrastructure of branches and ATMs. So even if they're just a few agents, the customers will be interested in going to that channel. On the flip side, banks don't face the same challenge attracting the cash merchants or stores that will serve as cash merchants or agents because the bank already has an existing customer base that that can easily start to migrate to the cash merchant channel. So as a result, the bank doesn't face the same chicken and egg problem that you see in other retail payment systems and can pursue a more incremental approach. There may be a few exceptions to this approach, however. In particular, in countries with low levels of financial inclusion, it may be that agent banking platform built by a bank may need to achieve scale quickly. And that happens, first of all, because they don't have the existing customer base that they can migrate to the new network of cash merchants like you might see in Latin America or markets with greater financial inclusion. And secondly, they also don't have the same infrastructure, the network of branches and ATMs that you might have in a country with greater financial inclusion. And as a result, customers don't see as much value in the bank's proposition. Another potential exception to the incremental approach is when a bank is looking to build an agent banking platform based on P2P transfers. In particular, that's when having a large network of cash merchants and of outlets in general where a sender can send money to and where they know that the recipient on the other end can take money out, especially critical. I'm not going to send money through a system where my mother is not going to be able to easily access money on the other end. So that's also a reason why reaching scale quickly may be particularly important. And I think you see this distinction between overall between being able to achieve scale incrementally when it's more driven by a bank versus other retail payment systems in the difference between the Brazilian model and M-Pesa. In M-Pesa, it took 2 years to reach the density of cash merchants that it took Brazil 10 years to reach. And that's not that Brazil wasn't successfully functioning over the course of those 10 years. The agents were sufficiently incentivized. They were able to slowly migrate their customers, and customers used the channel because they could also use the bank's ATM and branch network. There are a few things that banks need to take into consideration when they build agent banking platforms, and that are some of the key drivers of success that we've seen in Brazil and at its early stages in Peru as well. First of all, like any other retail payment system, the cash merchant or agent needs to be appropriately incentivized. And this is where the number of transactions that cash merchant sees per day and the commissions that they receive on those transactions is so critical. If the cash merchant isn't appropriately incentivized, they won't be interested in continuing to provide the service and ensuring that they have enough cash on hand and provide a good customer experience. Banks have a unique advantage in this because, as I said earlier, they're able to migrate customers from their existing channels to the cash merchant. And so that allows them to quickly reach some level of scale at that merchant that other retail payment systems will face a greater challenge in achieving. In new markets, however, if branches can't migrate their existing customers to the merchant, they will need to achieve scale as quickly as possible. And that's identifying a customer need that can serve as an early revenue driver and attract a large volume of transactions at that agent quickly is especially critical. And bill payments can serve as a potential source of early, fast transactions. But in particular, person-to-person transfers is a very interesting and high potential source of transaction volume. So this also means that models that have tried to build cash merchants in new markets where they can't migrate their existing customer base and to do it based on just providing financial products aren't as successful. And this is something that we've seen happen in Colombia, where banks have not successfully been able to grow their agent networks into new markets just by doing, offering access to savings and loan products, because the uptake of those services is much slower than bill payments or person-to-person remittances. A second key driver of success that banks need to take into consideration when they build an agent banking platform is managing that network of cash merchants. It's critical to identify the right cash merchants and to manage them effectively and efficiently on an ongoing basis. That means weekly visits to ensure that the cash merchants are providing a good customer experience, consistent customer experience, and have enough cash on hand. Because if not, you're going to lose the customer's trust in the system, and they may not continue to use it. Banks have an advantage versus other retail payment systems because they don't just have to depend on third parties to manage that network of cash merchants. They can also use their branch and internal and regional channel management structure to actually manage those agents. So this is something that you see for example, in Banco El Crédito in Peru, where they've now integrated the management of the agent network into their channel management structure. And so there are regional agent managers housed in branches managing agents across the country and able to go on a regular basis to the agents to ensure that they're providing a good customer experience.